We're continuing our discussion about understanding business valuations and begin part 2 with several case studies that were conducted by the firm. Our first case study is an architectural firm with whom we did an actual business valuation. The architectural firm had been very profitable in years past, but the architectural industry was one of the hardest hit by the downturn in the economic crisis. In most recent years, 2010 and 2011, after paying their owner a fair wage, there was zero cash flow left over. So under the formula, cash flow times multiple, we get zero value under the income approach. In our second case study, we have an IT company. Again, an actual valuation that we did where the IT company has a normalized cash flow of $1 million. We then go about the process of developing the cap rate, and it came out to about 19.6%. But for illustration purposes, we're going to round it off to 20%. This 20% cap rate is a 5 multiple. We take the 5 multiple times the $1 million of free cash flow, and we get an income approach value of $5 million. Let's step away from these case studies until after we've calculated the second approach to value, which is the asset approach. In the asset approach, we add up the value of each asset separately. It's the market value, not the book value of those assets that count. So what can we resell each of these assets for separately in the marketplace? What you're going to find is that the asset approach is most useful in liquidation, and I'll explain that to you a bit later. Through the asset approach, we look at the value of the office equipment, the furniture, the machinery, and any other assets the company has. We go through and we look for a ready third market for each of those values. Now, as you can expect, a lot of the assets that you have will have relatively nominal value. For instance, a new computer you buy. On the first day you put it in your business and you start working on it. What is the resale value and what are you going to resell it for if you put it out on Craigslist? How much money would you get for it? The reality is, we know it would be nominal compared to what you paid for it. Ultimately, most of the minor assets in your business are not important when it comes to the asset approach. They have very nominal or minimal, even zero value. But significant equipment is a different story. Not long ago, we did a valuation for a spinal doctor, and he had an MRI machine that was specialized for doing x-rays of a person's back. When we went out to market, we were able to readily identify very similar equipment for sale for significant values. The most significant values are the only ones that are really going to be considered in an asset approach. One of the key points with the asset approach is to understand that it's the total value of the asset's resale value in the marketplace. And what may be of interest is that the income value minus the asset value actually equals your blue sky or value of goodwill. Everybody likes to learn what blue sky is all about, and that's the goal in business, to create value beyond the value of the assets that you purchase. So, if you can go out and assemble a bunch of assets and put them to use in a business and create an income value that's in excess of the asset value, then you've actually created equity and created value in your business. Look at this example. All the assets in this business total up to $1.3 million. The income value, $5 million, minus the asset value of $1.3 million equals blue sky of $3.7 million. So, if you were buying this business, you'd be buying $1.3 million of resaleable assets plus $3.7 million of goodwill. Again, goodwill being represented by the amount that the income approach exceeds the asset approach. Now, let's go back to our case studies and look at the architectural firm. We went through their balance sheet and looked at all their assets, liabilities, etc., and we came up with an asset approach value of $100,000. Moving on to our IT company, we went through their balance sheet, looked at their assets, market values, etc., and came up with an asset approach value of $1.3 million. Now, let's move on to the third approach to value, which is the market approach. Under the market approach, we develop a value based on sales transactions of similar companies. Here's the search results from a common database that we use. This example happens to be automotive repair and maintenance services. Where you see MVIC, that's market value of invested capital, divided by sales, tells us sales price divided by sales is 0.4, or 40%. So, in other words, if you had a business that was an automotive and repair shop and you had $1 million of sales, we would multiply your $1 million in sales by 40%, which is the average sales price in the marketplace that similar companies sold for, and we would get a $400,000 value. $1 million in sales times 40%, or $400,000 value on the market approach. Some might call this calculation the rule of thumb. You may hear an insurance company sells for 100% of gross sales, or an architectural business sells for 60% of gross sales. These market multiples are actually very accurate when it comes to middle market or bigger companies, but there are a number of reasons why these sorts of rule of thumb are not very good for smaller companies. Here's why. We use these market transactions mostly as a reasonableness check that you can use to ensure that your data is what is expected. Because with most small companies, their accounting methods vary substantially. You've got most small businesses keeping accounting records to file tax returns. And on a tax return, the very same company that's a sole proprietor versus a corporation or a partnership will have a substantially different looking bottom line, different looking accounting records. Whereas if they're a very large company, like a publicly traded middle market company, they will have accounting people on staff that keep financial statements for generally accepted accounting principles. A financial statement done under generally accepted accounting principles is comparable from one company to the next, regardless of tax basis of accounting or accounting method that they use for taxes. You need to ask yourself this question. In your small business, do you keep your records for generally accepted accounting principles? Or do you keep your financial records because you need to file taxes? Most people keep them because they need to file taxes, and because the accounting methods are so different, a lot of the market transaction data is not comparable. Some other reasons are there are few comparable company transactions, the locations of the comparables matter, and the uniqueness of the business or product is also sometimes difficult to find comparable transactions. In fact, we just did a business valuation for a company, and we found 28 comparable transactions. It sounds like a lot, but it was over a 10-year period in 27 different states. So when you really dive into the reports, you realize it's just not really all that comparable or reliable information. So, we look at market transaction data as simply a rule of thumb, giving us a small hint as to approximately what kind of value we should see. Now, let's go back to our case studies, and looking at the architectural firm, we'll calculate the market approach value. The firm was projected to have $760,000 in sales. Market transaction data told us that architectural firms sell for about 60% of value. Under the market approach, we get a value of $456,000. Now let's go to the IT company. The IT company was projected to have sales of $8 million. The IT company also showed a market transaction comparable at 60% of sales. When we multiply 60% times the 8 million, we get a value of 4.8 million under the market approach for the IT company. Now let's summarize each of our case studies. First, the architectural firm. If you'll remember, under the income approach, the architectural firm had a zero value. Under the asset approach, the architectural firm had a $100,000 value. And under the market approach, the architectural firm had a value of $456,000. So when we issue our report as valuation analysts, what value was given on this business? The answer is $100,000 for the asset approach. If you sold this business for the market approach value of $456,000, you would likely get it back, because the new buyer needs to rely on the cash flow from that business to service the debt or the money from the investment that he made to buy it. And with the income approach being zero, there won't be any money to service that debt. Now, you've heard of a lot of people who sell their businesses on contract and get them back in a big mess. This is how that happens. They relied on a market approach transaction where the income didn't support that, and therefore the transaction was doomed for failure from the beginning. The asset approach here is a liquidation value. The liquidation value is basically what can be collected from its sale, and it's typically lower than fair market value. If you want to create wealth in your business, the income approach to value has got to exceed the asset approach to value. Let's go on to the IT company. In the IT company's case, if you recall, the income approach, we gave a value of $5 million. The asset approach, we gave a value of $1.3 million. And under the market approach, we gave a value of $4.8 million. Now, what approach did we use or rely on? And what value did we give it in our report? $5 million under the income approach. The income approach is the most credible source of value. It's the one approach you want to focus on. I'd like to recap this section by just telling you that the critical drivers of value are cash flow and multiple. We can see how market data is not that reliable, and we can see that the asset approach is a liquidation value. And we can see that the way to create wealth in your business is to improve the cash flow. When you sell a business, what you're selling is the cash flow stream. It's the return on investment that the buyer is buying. In order to make your business the most saleable for the strongest value, focus on your cash flow. Now, in our final video, Part 3 of Understanding Business Valuation, we'll compare small businesses to middle market and larger corporations when developing a business valuation.